Good morning, ladies and gentlemen. It is my pleasure to welcome you to the Czech National Bank's first meeting with analysts of this year, which follows yesterday's monetary policy meeting of the Czech National Bank's board. First, let me introduce the speakers for today. Although you have known them for long, they have been here in their brand new roles today. The CNB board is for the first time represented here by a new board member, Tomáš Holub.
Good morning.
Who joined it only in December. And the other speaker is Petr Král, Tomáš Holub's former deputy and his successor to the post of executive director of the Czech National Bank's monetary department, or if you prefer, the Czech National Bank's chief economist.
Hello to everyone.
In line with the tradition, we shall start with the presentation of a new quarterly economic forecast, which served as the basis for yesterday's decision by the Czech National Bank board to keep interest rates unchanged for a second session in a row. It will be presented to you by Petr Král. So, Petr, you have the floor.
Thank you for the floor. Once again, good morning, everyone. It is really my great pleasure and honor to be here in my new role, delivering CNB's presentation on the new macroeconomic quarterly projection. My presentation will have the following structure. I will start by introducing the assumptions on which the new forecast is based. Then I will provide you with a very in-depth insight into the story of the new macroeconomic forecast, including its quantitative dimensions regarding individual variables. After that, I will briefly compare the new forecast with the previous one, and the final part of my presentation will be dedicated to showing two sensitivity scenarios which illustrate major risks that we faced when preparing our new macroeconomic forecast. As for the assumptions of the forecast from the external side, those are based on January publication of consensus forecasts and on updated market outlooks. As you well know, the euro area or European economy has been showing some weakness in recent months, and according to this January consensus forecast, we can expect that GDP growth in the effective euro area will slow to 1.5% this year and will only slightly accelerate to 1.7% in 2020. A recent sharp decline in crude oil prices, which are shown on the right bottom panel, has been transmitting itself into the disinflationary pressures in the effective euro area. And these pressures are leading to the deceleration of producer prices growth we can expect in the quarters to come, and foreign PPI growth will only gradually return to 2% growth next year. Having seen this economic weakness and those new information from the price from the inflation side, the ECB has somewhat changed its communication. The ECB ended its asset purchasing program, but will start increasing its interest rates only after some time, and probably that's why the market outlook foresees that the three-month Euribor rates will remain in a negative territory until the end of 2020, which is the entire forecast horizon. Czech public finances have been benefiting from the fact that Czech Republic has been enjoying still quite economic good times. So we have seen budget surpluses in recent years, and according to this, to our new forecast, these budget surpluses will be here for both 2019 and 2020, which will primarily reflect continued economic growth, which is having a positive impact on tax revenues, on the revenue side of public budgets, together with some fiscal discretionary measures taken by the government in recent years to improve tax collection. Those fiscal discretionary measures are manifesting itself themselves also in the government surpluses in structural terms, which will be above 1% over the next 2 years. So the medium-term objective for Czech public finances will be comfortably met. And following this positive budgetary outcome, we can expect that the debt to GDP, public debt to GDP ratio will continue to decline below 30% in the end of the forecast horizon. The real government consumption as a particular domestic demand item will grow by approximately 2% both this year and the next. As for the fiscal impulse, which is something we need to incorporate into our quarterly macroeconomic forecast to catch the ultimate effects of fiscal policy. So this fiscal impulse was significantly positive, significantly expansionary last year, following some measures stimulating private consumption and following the renewal of rapid growth in capital expenditures in the public sector. This year, the expansionary mode of the public government, of the public finance will prevail, but it will be a bit more moderate, making a contribution to the GDP growth of approximately 0.4 percentage points, and this positive contribution will be mainly related to the private consumption support, which will benefit from continued rise in public sector pay and by some extra increases in old age pensions. And the government gross fixed capital formation in the public sector will also continue to grow as we are in the more mature phase of the current EU programming period, and projects co-financed from the EU funds will especially contribute to this part of government investment growth. Now let me highlight the basic main messages of the new forecast. After some slight temporary increase at the beginning of this year, inflation will move back to inflation target, to 2% inflation target of the Czech National Bank, and will be very close to this target for the rest of the forecast horizon. We can expect that GDP will grow at approximately 3% in both 2019, 2020, and this continued growth will be driven by all components of domestic demand, whereas the net exports will make a negative contribution this year, and this will change a bit for the year 2020. The continuing economic growth is reflected in the tightness on the labor market, which prevents the rate of unemployment from further decline and the overall employment from further increases. this tightness on the labor market will lead to persistent, swift wage increases, which will gradually decline, but as I mentioned, relatively gradually. We estimate, we expect that the negative sentiment on the global exchange markets and the shift of portfolios of global investors from emerging economies to other economies that those investors perceive as less risky will gradually disappear, and koruna will return to appreciation. This appreciation will be this year promoted by the widened interest rate differential vis-à-vis the euro area, and on the whole forecast horizon, the appreciation trend will be supported by the real convergence process of the Czech economy. Consistent with the new macro forecast is a broad stability of nominal interest rates over the whole forecast horizon. Inflation dropped down to exactly 2% during the last quarter of the previous year, which mainly reflected the sudden fade out of previous food price growth and some deceleration in fuel price inflation. This fuel price inflation came down as a response to the sudden and sharp crude oil price decline. On the other hand, core inflation, which has been the major driver of the overall inflation for the last couple of years, has increased a bit in recent months, and especially non-tradable component of this core inflation went up. So prices in service sectors are growing quite visibly. The tradable component of core inflation was brought to stability in year-on-year terms, and some slight increase came only in December last year, which might have been a reflection of the weakening of the Czech koruna in the previous months. The administered price growth also contributed quite significantly to the overall price growth in the recent months, and some further acceleration of this segment is in the pipeline, and I will be speaking about it later on. According to the forecast, we can expect that inflation will pick up somewhat during first 2 quarters of this year, and after that it will move back to 2% inflation target and will stay very close to the target for the rest of forecasting horizon, including monetary policy horizon. The initial acceleration could be primarily attributed to the administered price increases, especially in terms of energy prices for households. Monetary policy relevant inflation will be only negligible different from the headline inflation, as the forecast incorporates just one particular item of indirect tax changes, which is the decrease in value-added tax from 15% to 10% in the case of public transportation. And the primary impact of this measure is minus 0.06, so minus 0.06 of a percentage point. That's why the monetary policy inflation will be only marginally above the headline inflation, as we expect that this decrease in VAT rate in this particular item will not be translated into the actual decline of prices in this segment. As I mentioned, we are approaching the period in which administered prices will generate more substantial contribution to the overall CPI growth, which is a reflection of the previous significant increase of energy prices in the world, on the world markets, especially electricity on commodity exchange rose in the recent quarters, and this will be transmitted to the electricity prices for Czech households, together with some increases of natural gas and heating. On the other hand, this segment of inflation, administered price growth, will be somewhat curbed by the fair discounts in public transportation for specific groups of citizens, such as students and pensioners, which were introduced in September last year. In 2020, the dynamics of administered prices will go down. Fuel prices are heading to a year-on-year decline, as the sharp decline in world oil prices are going to be passed through to the domestic fuel prices in these months, and this decline will even further be deepening, reflecting besides the crude oil price effect, also the renewed appreciation of the currency vis-a-vis euro and especially dollar in this particular respect. Core inflation, which is, as I mentioned, the major driver of the overall headline inflation, will pick up somewhat in the months to come, which will be reflecting the still very robust overall inflation pressures, especially domestic inflation pressures. And the initial increase will be also promoted by the previous weakening of the currency. The price growth in this core inflation segment will again be especially visible in the non-tradable sector. Later, we can expect that the expected renewed appreciation trend of the domestic currency, together with some gradual slowing down of total inflation pressures in the economy, will lead to some deceleration of core inflation in the following period, and core inflation will be close to 2% in 2020. Food price growth that almost disappeared in recent months will recover again, following the fact that some agricultural prices are going up, reflecting poor harvest from the last year because of very hot and dry weather conditions. The picture on the in the background of these profiles of individual inflation segments is such that we are now in the situation where the overall inflation pressures, after culminating in last year, are going down. And this is particular the reflection of the import price contribution, which is going to be anti-inflationary, and its anti-inflationary effect on domestic inflation will even strengthen over the next couple of quarters. Whereas the domestic fundamental inflation pressures will only gradually be diminishing. And this diminishing of domestic pressures will be related to gradual slowdown in nominal wage growth in business sector, which after some temporary increase at the beginning of this year, which is related to further increase in minimum wage, will gradually disappear, but this deceleration of wage pressures will be only visible or will be more visible only in 2020. And the persistent wage pressures, as you can see here, will be for the whole forecast horizon compensated or offset by persisting productivity gains, reflecting the labor efficiency growth. The Czech GDP growth has decelerated in recent quarters, and that's why the positive output gap has narrowed. So the Czech economy is currently working somewhat above its potential, but the output gap, which was more marked before, has narrowed, as I mentioned, and we can expect that the GDP growth will be close to 3% over this year and the next. So the growth rate of GDP in our forecast is very close to the estimated potential output growth rate. That's why the economy as such will be operating close to its potential over the whole forecast horizon. The major drivers of the continued economic growth will be private consumption and gross fixed capital formation. This will be happening against the background of a positive fiscal impulse for this year, as I already mentioned when commenting on the fiscal side. And net exports will hinder economic growth this year because of the subdued export performance of Czech enterprises. Now let me mention a few details about individual components of the overall demand. Household consumption will benefiting from continued, despite slowly decelerating growth in wages and salaries. So we can expect that this component of domestic demand will remain a major driver of the overall economic growth. Firms are facing the shortage of available labor force and started to invest more into machinery and equipment and into digitalization and robotization, and this phenomenon will continue according to our forecast, and the overall gross fixed capital formation will be promoted by public sector, where, as I mentioned, Czech authorities will try to spend as much money from the EU funds as possible during this EU programming period. The export performance is currently muted, which is a reflection of both fundamental and non-fundamental factors. Among those fundamental factors belong the gradual deceleration of foreign demand and some kind of losing competitiveness of domestic enterprises vis-à-vis their competitors from the outside world. This losing competitiveness is a reflection of a persistent domestic wage growth, which is much higher than what we can see in the other countries. And recently, this loss of competitiveness, and for the future, this loss of competitiveness will be promoted by the rapid decline in foreign producer prices growth. Non-fundamental factors that contributed to the deceleration of export in last quarters were primarily related to the new environmental regulation in car industry. We can expect, but that this one-off effects will gradually disappear, and together with some acceleration in foreign demand growth, Czech export performance will also accelerate in 2020. As I mentioned, the continued economic growth is still manifesting itself primarily on the tightness on the labor market. The firms are still complaining about unavailable labor force, and the Czech labor market is almost fully exhausted. That's why the room for further employment increases is very limited, and the same is true for the possible further decline in the rate of unemployment. So the further employment increases will be covered only by gradually increasing labor force, which will be reflecting still positive demographic factors and increases in participation rates in specific social groups or cohorts, such as the people approaching the statutory retirement age, or women after their paternity or maternal leaves who are now more inclined to start working. So the story about the unemployment rate is such that we cannot expect any material further decline in the years to come, because we have got to the bottom. The lively or swift nominal wage growth in business sector will continue for some time. At the beginning of this year, this growth will be promoted by another increase of minimum wage, which was introduced by the government, and the increase of the minimum wage is approximately 10%. But gradually, the slowing down of the economy will be reflected in the gradual deceleration of nominal wage growth in business sector. And in the same direction, there will be a pressure from Czech enterprises on wage growth to curb it in order to preserve their competitiveness and profitability. Much more pronounced decline profile can be expected from the development in non-business sector. After double-digit growth in the recent quarters, we can expect some swift deceleration to approximately 7–8% during this year, and further deceleration in this segment in 2020. Despite the fact that our forecast incorporates wage increases for teachers of 15% and for other public employees of 6%, which has just happened at the beginning of this year. The near-term forecast, or the near-term outlook for the exchange rate trajectory was set at 25.6 koruna per euro, which reflected the development on the exchange rate market until approximately mid-January. The forecast assumes that the negative sentiment that led to some weakening of the currency, not only in the Czech Republic, but also in some other emerging economies, will gradually fade away, and koruna will revert to appreciation trend. This appreciation trend will be promoted by widened interest rate differential vis-à-vis euro area, and by a continued real convergence process of the Czech economy. The appreciation will be especially significant during this year, and in 2020, appreciation will slow down and will be broadly in line with the real equilibrium exchange rate trend. Consistent with the new macroeconomic forecast is a broad stability of domestic nominal interest rates. The upward pressures on the rates is being given by weakened koruna in recent quarters, and by persistently robust domestic inflation pressures. together with some expected pass-through of accelerated growth of regulated prices into other components of the headline inflation. On the other hand, this upward pressure is counterbalanced or offset by expected renewal of the koruna nominal appreciation, which will start very soon according to the forecast, and by the expectations of negative nominal interest rates in the euro area for the whole forecast horizon. So these downward pressures roughly compensate the upward pressures from the weakened koruna at the beginning of forecast horizon and the upward pressures from the domestic economy, and the result is relatively flat interest rate path in this new forecast. Let me now provide you with a brief comparison of the new forecast with the previous one. The most important change is the downward shift or anti-inflationary shift in almost all foreign variables that that we incorporate into our forecast. As I mentioned, crude oil prices, foreign producer prices, and foreign GDP have been revised downwards, and this has been reflected by downward revision of the expected interest rates in the euro area. From the domestic point of view, some change in the forecast is, let's say, expected later renewal of the appreciation of the koruna, which will start appreciating only gradually this year, so a little bit later compared to what we anticipated in our previous forecast. Inflation forecast has been revised downwards in the one-year horizon and remained virtually unchanged for 2020, including the monetary policy horizon. The downward shift at the short end of the forecast horizon was given by the lower than expected figures for the last quarter of the previous year, together with some more anti-inflationary effects of import prices we forecast now. The increased regulate price growth is acting in the opposite direction. The new forecast leads to negligibly higher interest rates at the beginning of the forecast horizon compared to the previous outlook, mainly due to weaker initial exchange rate level and because of higher outlook for administered prices. On the other hand, the more distant part of the interest rate path is being pushed downwards in this forecast compared to the previous one by the effect of the downward shift of foreign nominal interest rates. The GDP growth has been revised. The GDP growth forecast has been revised somewhat downwards. Here you can see what I've just said about inflation. The downward shift is visible in the during this year, whereas on the monetary policy horizon in 2020, the forecast remained virtually unchanged. The downward revision at the beginning reflects the lower observations for the last quarter of last year and the less intensive price pressures from abroad. GDP outlook was revised downwards, which primarily reflects worse outlook for foreign demand growth, together with some more deteriorated competitiveness of domestic producers, which reflects lower foreign producer prices growth and also some effects of more persistent wage pressures in the Czech economy. As for the wage growth as such, you can see here that the forecast hasn't been changed much. Short-term indicators suggest that nominal wage growth dynamics nominal wage growth in business sector at the end of last year and at the beginning of the new year was somewhat affected by extra bonuses paid in several sectors and enterprises, and together with some persistence, this will lead to the fact that this forecast hasn't been changed much compared to the previous one, despite the fact that we somewhat reduced the inflation outlook and the GDP outlook. The exchange rate outlook has been shifted somewhat to the weaker side because of the expected slower or later evaporating of the negative sentiment effects. So in this forecast, the negative sentiment is fading away somewhat later compared to the previous one, but then the trajectory of the nominal exchange rate is quite swiftly moving back to the previous forecast. The forecast of the nominal interest rates hasn't been changed much. It was somewhat shifted upwards at the beginning of the forecast horizon, and it is somewhat below the previous forecast in 2020. Here you can see the composition of this interest rate forecast change vis-a-vis the previous forecast. The initially slightly higher nominal interest rates are due to a weaker koruna. We have observed in recent months compared to what we anticipated before, including the expert judgments that catch the fact that the fade away of the negative sentiment will now come a little bit later compared to what we expected before. And in the same direction, the expected accelerated growth in the regulated price segment is acting in the same direction. The reduced foreign interest rate outlook, the flatter market outlook for 3-month Euribor is making downward pressure on the domestic interest rate path over the whole forecast horizon, and this effect will prevail, especially in the end of the forecast horizon. That's why there is a small downward shift reflecting this factor for 2020 compared to the previous outlook. Let me now briefly show you results of our two sensitivity scenarios we prepared to illustrate some risks we faced when we were preparing our new forecast. As you know, the nominal exchange rate development has been surprised us on the weaker side in recent several quarters. So the exchange rate uncertainty is still quite huge, and this uncertainty is traditionally described by exchange rate sensitivity scenario. In last year, we had standard plus minus 3% sensitivity scenario. After that, we had some more fundamental version of this sensitivity scenario, and now we are offering another version of this scenario, which assumes that koruna will be at the same level, which is 25.6 koruna per euro for the second quarter of this year, which is simultaneously the starting condition for the forecast. So the expected appreciation will come a quarter later compared to the baseline. And we're asking ourselves, or the model, what will be the expected outcomes of such an assumption. And you can see that this will generating some upward pressures on domestic interest rates, via which the monetary authority tries to react to the increased import price pressures compared vis-à-vis the baseline. So the import prices, which are fueled by weaker currency, are compensated by some higher nominal interest rates. Despite this reaction of monetary policy, inflation is somewhat above the baseline scenario, but only relatively marginally. And after the initial exchange rate shock disappears, all the variables are gradually reverting or returning to the baseline scenario. Major uncertainty concerning foreign outlook and external side is a potential hard Brexit or Brexit, no deal Brexit, or disorderly Brexit of the UK leaving the European Union at the end of March. In this scenario, we assumed that the UK will leave the European Union without withdrawal agreement. So we, in this scenario, assume that this fact will damage mutual trade and other relationships between the UK and its major trading partners, which is the euro area. In this scenario, so we expect a sharp drop in mutual trade linkages between euro area and the UK, and between the European Union and the UK, including the Czech Republic. So this is a kind of negative foreign trade shock to both UK economy and the European economy, but the effect on the UK is quite naturally much bigger, approximately 6 times bigger than on the euro area in terms of the decline of GDP growth. So the chaos at borders and some obstacles for foreign trade will lead to the fact that GDP growth in the euro area in this scenario will decelerate much more visibly compared to the baseline. The GDP in the euro area will grow only by 1% during 2019, and according to the depreciation of sterling and of the euro against the dollar, there will be a pro-inflationary impact of this scenario. So the PPI growth in the euro area will be significantly above the baseline scenario, which will be promoted by the expected effects of new tariffs that will be imposed on a mutual trade between the UK and the rest of Europe. In this scenario, the ECB's monetary policy remains virtually unchanged compared to the baseline. So our economy in this scenario will be primarily hit by the collapse of, or by the less intensive foreign demand from the euro area. This is the primary channel through which is Czech economy hit by this hard Brexit scenario. So the this could be interpreted as a foreign demand shock for the Czech economy, together with some NFA shock, because the Czech economy is generating persistent trade balance and service balance surpluses, which are pushing the exchange rate to long-term appreciation and less intensive export performance of the Czech economy will simultaneously generate some pressure on the exchange rate weakening of the Czech koruna. And besides this effect via the euro area, the Czech economy will be also affected by direct trade linkages between our country and the UK. But this channel is relatively limited because of the fact that the UK is the fifth, despite being the fifth most important trade partner of the Czech Republic, its share on our total exports has been diminishing over time. So this channel is relatively limited compared to the previous channel via the euro area. So in domestic economy, the response is such as follows. The currency has a tendency to depreciate vis-à-vis the baseline, following the fact that this hard Brexit scenario is in the model interpreted as a foreign demand shock and net foreign assets shock. This depreciation of the currency together with foreign demand, with foreign inflation, which is going up, is transmitting into the domestic economy via bigger import price pressures. That's why there is a underlying tendency for inflation to go up, and the monetary authority to fight against this potential overshoot of the inflation target has to react to this underlying pressure by increasing nominal interest rates. And this increase of nominal interest rates is counterbalancing the effect on the exchange rate in the first moment, and simultaneously the lower foreign demand is generating some more pronounced GDP decline or GDP growth decline in the Czech economy. As you can see, the GDP growth is lower in 2019-2020 by approximately half of a percentage point. So the domestic inflation and pressures are counterbalancing the higher import price pressures. That's why the ultimate outcome in terms of CPI inflation is relatively unchanged compared to the baseline. The GDP is pushed downwards not only via lower exports and lower contributions of net exports to GDP, but subsequently also by the response, endogenous response of domestic demands, because firms and households are spending less following the less optimistic macroeconomic situation. Let me stress here that this scenario works only with trade linkages. So the effects on domestic economy and on the economy in the euro area abstracts from any potential effects via worsened sentiment or via financial interlinkages between London and the rest of Europe. So this is just an approximation of the direct trade channels in this scenario. Having said that, I would like to thank you for your attention now, ladies and gentlemen, and I am passing the floor back to Markéta.
Thank you, Petr, for your most interesting presentation. And before we move on to a debate, I'd like to ask those of you who would like to pose a question or make a comment to first introduce themselves. Well, let's start with the first question. Radomír Jáč.
Radomír Jáč, Generali Investments. Good morning. I have a question for Mr. Král. The question is related to forecast of household consumption growth for this year. You are predicting some acceleration, albeit slight compared to 2018, but still it's quite interesting given the assumption for weaker growth of real wages, slower growth of employment. So I want to ask what is behind. Is it impact of pensions, minimum wage, or changes in savings, or whatever? Thank you.
can you take it?
Thank you for the question. You are right that besides wages and salaries, there are some other important parts of the gross disposable income which is used by households for paying for their consumption, including social benefits, including entrepreneurs' revenues, etc. And we, in this forecast, take into account the extra increases in pensions and increases in those other segments of disposable income, which are basically reflecting the fact that the domestic economy so far and for the future as well is going quite well, and entrepreneurs in the service sector, which is oriented on the domestic demand, has been enjoying quite good economic good times. So we have this significant positive contribution of in the overall disposable income dynamics.
Thank you. Another question? Yes, the okay. Yeah.
Good morning. Thank you. Good morning, ladies and gentlemen. My name is Lukáš Kovanda. I'm from Czech Fund. I would like to ask you, because you are not expecting in your basic scenario some worsening of global situation. On the other hand, you are expecting fading away of the global sentiment. So is it right when I'm thinking that you don't expect hard Brexit and further escalation of trade war between China and the United States, or United States and European Union? You have said that in your basic scenario you don't expect probably hard Brexit, but could you be more explicit about this? Thank you very much.
The baseline scenario is consistent with kind of smooth foreign developments, despite the fact that January consensus forecast has reflected the fact that the situation in the world economy has been getting a bit gloomer compared to what we saw or what they expected before. So the worsened GDP outlook for the euro area was incorporated into the new forecast. And beyond the January consensus forecast, we even lowered the in the baseline scenario the foreign demand outlook, because of the fact that we were persuaded that foreign analysts are not taking proper account of the latest available figures from industrial production and from other segments of the euro area economy. That's why we a bit kind of anticipated future revision of this consensus forecast, which might come in February. But still, this is baseline scenario is without hard Brexit, without trade wars. This is just a reflection of a gradually a bit weakening economic situation and worsening sentiment, which is by no means indirectly affected by longer-term uncertainties and accumulating global factors. But those are here without such dramatic events, which are not part of the baseline scenario.
Tomáš Holubov would also like to comment on this one.
I may follow up on that. During the board meeting, we basically agreed, or the majority view was such that there is still reason to believe that much of the slowdown in foreign growth that we observed in the second half of last year was driven by one-off factors, such as the ecological regulations in the car industry and some disruptions to chemical industry in Germany, etc. So the baseline view is still some gradual re-acceleration of foreign demand during this year. So we remain relatively optimistic as regards the baseline outlook. But of course, we also had a lot of debates concerning the external uncertainties, including the Brexit. We very much welcome the sensitivity scenario prepared by the staff, but of course it's a sensitivity scenario. It's not a fully fledged alternative scenario or a new forecast that would be incorporating all possible aspects of the Brexit. So we really had a debate on how to incorporate those external uncertainties into our decision-making process, and the ultimate decision was, or majority view was, that we are not under any kind of urgent pressure to continue with normalization of monetary policy, and we can wait a bit until we see some new pieces of information related to the external environment. You know that our next policy meeting will be in late March, just one day ahead of the planned Brexit. So by that time we should have some new information regarding that. We may also wait until we see some data confirming that the European economy is regaining some of its previous momentum, and this was really very much a part of the debate, those external uncertainties, including the Brexit.
Pavel Sobíšek.
Pavel Sobíšek, Unicredit Bank. Let me follow up with my question to what Petr Král said just before. So the assumption for effective Eurozone at 1.5% was adjusted versus consensus forecast from that time, or does it mean that you went down from the figure of 1.5% for effective Eurozone? I'm asking because yesterday the European Commission presented its outlook for GDP, and if I derive the effective Eurozone from their forecast, as you define it, the figure would be just 1.2 for GDP growth. So my question is whether you have already reflected part of the shift down which the European Commission did yesterday. Thank you.
The expected GDP growth in the euro area I presented when explaining the external assumptions is including the expert judgment. So 1.5% is after the consensus forecast has been adjusted downwards by our expert judgment.
So how would you interpret for your forecast the downward shift made by the European Commission now?
This is information which came up after we completed the forecast, so it couldn't be in any way incorporated into the forecast, and it's basically the question possibly on the interpretation of the forecast for monetary policy considerations. So this is something maybe to ask Tomáš Holub about. From the forecasting perspective, it is clear that there were some more gloomy indicators in recent months available, but some hard evidence was saying that we are not approaching an economic recession in the euro area and in the Czech Republic. We are just moving back from above to the potential, and that some deceleration of GDP is just a reflection of the fact that economies, especially in Germany and the Czech Republic, were hitting the production frontiers. So if you look at, for example, a survey among domestic entrepreneurs, they still complain about unavailable labor force, they complain about some shortage of materials and other subcomponents. So this is kind of, from our point of view, kind of healthy deceleration of GDP from above the potential to the potential level. and some one-off factors that affected German production, such as some irregularities in taking holidays during summer, problems with transportation in Rhine because of low level of water, which affected some chemical industry and pharmaceutical industry. Tomáš already mentioned the effects of new environmental regulation, and in car industry there was another regulation type obstacle for pharmaceutical industry connected to some new regulation on cancer cures. So this is these factors, these one-off factors will definitely disappear, will definitely fade away. And from a macro fundamental point of view, there is no need for European countries to go into a more marked or more pronounced economic slowdown. So the revision of the European Commission forecast is some signal in this discussion, but we are quite sure that Czech economy is not heading any economic recession.
I can just repeat what I said. Basically, relative to the analysis provided by the staff, we decided to stay on the cautious side in the near term, also taking note of the fact that the recent stream of data from the European economy was soft. And I assume that this softness of the last data releases somehow also affected the Commission's forecast. We don't question much the medium-term outlook. We still see it as a baseline that some re-acceleration will take place. We had, of course, some discussion not just on the European economy, but for example on China. To what extent is the Chinese slowdown structural, to what extent it will be well managed, and what are the implications for the Czech Republic through the German export chain. But in general, for the medium-term policy outlook, the board was quite okay with the presented analysis, and if anything, we saw some upside risks related to the fact that the forecast includes relatively swift appreciation of Czech koruna, and while we believe that if the good news proves to be correct, koruna will resume appreciating. Of course, the pace may be slower than what the forecast envisages. So in the end, we saw the risks as slightly skewed to the upside, which might imply a bigger scope for policy normalization in the medium term than what's suggested by the forecast.
Thank you. Another question comes from Jakub Seidler.
Hello. I have two questions. One for Petr Král. We have seen that koruna is much more muted towards the Eurozone interest rate differential for many quarters. So are you planning some changes in model assumption regarding that? Because it has been a few forecasts we have been discussing, the mutual reaction of koruna. Still, it has been muted, so maybe after some time you will try to revise the forecast. And the second question, maybe more for policymaker, looking at the sensitivity scenario for koruna, which might remaining at 25.6 in the second quarter 2019, which might be more baseline according to market opinion right now. We see quite a strong reaction in the interest rates increase, maybe 2-3 hikes more. So can you imagine that the board members would be really willing to act so aggressively, taking into account that the global environment will not improve, will not deteriorate, but looking just at this sensitivity scenario, the hikes are now then quite strong in quarters ahead. Thank you very much.
So Petr, can you start with the first question?
We have been paying proper attention to the fact that in the recent quarters, the exchange rate was surprising us on the weaker side, and we are considering some improvements into our forecasting architecture, forecasting model, but I'm not now authorized to share with you the expected future waves of improvements.
Tomáš, please.
Well, as I mentioned, we view the risks for the interest rate outlook as skewed slightly up, and this relates basically to the exchange rate outlook as embodied in the sensitivity scenario. Of course, in terms of how it is constructed, it's a pure exchange rate shock. So it assumes that on the one hand, the global economy or a foreign environment would be evolving in line with the basically optimistic outlook embodied in the forecast, and on the other hand, Koruna would be appreciating more gradually. So it's a kind of scenario in which there is this straightforward ceteris paribus link between exchange rate and interest rates, the one that we more or less faced last year when Koruna was not appreciating as expected, but otherwise the economy was basically moving along the forecasted path. Of course, if you bring into account that foreign environment may develop in a less positive way than what we have in the baseline, this ceteris paribus, all other things being equal stuff, no more works as mechanically. And there was, I think, a broad understanding of the board members that slower appreciation would be an argument for more hikes than what we have in the baseline, but also some board members repeatedly emphasized that we are not targeting exchange rate. It's just one important factor of the future inflation process, and if it partly reflects weaker external developments, this direct link might break down. It wouldn't be that automatic as we were used to last year.
Thank you. Michal Skořepa.
Thank you. Michal Skořepa, Česká spořitelná. My question concerns the yield curve, especially the long end of the yield curve has fallen or fell over the last 2 months of last year, let's say, to levels well below 2%, and it stays basically there. And this is the end of the curve, which is important, for example, for pricing of mortgages for banks. So this development might be important for transmission of monetary policy. So my question is, do you have any specific ideas about what caused this effect, and is it permanent? Because these levels below 2% don't seem to be in line with some kind of basic macroeconomic ideas about long-term interest rates, nominal interest rates in this economy. Thank you.
Maybe I'll start with an argument that so far the transmission of monetary conditions, tightened monetary conditions into the development of Czech financial sector has been working quite nicely. We, after having some time delay in transmission of monetary policy rates into the client rates of mortgages, we have in recent months seen some swift pickup in those rates. The same is true from the very beginning of the tightening cycle for interest rates for corporate credit. So far, we were not worried about the functioning of the monetary transmission. The effect on the yield curve, on the flattening of the yield curve in the recent weeks and months is something we are now studying. There are quite usual suspects as foreign contagion or foreign factors. the yield curve has been flattening globally in the world. The market now expects that the Fed will start declining interest rates in 2020, which is kind of change compared to what the market expected a few months before. So those factors are definitely affecting all the economies around the world, including the Czech Republic, and we will have to monitor the situation very closely to get to know whether this might or might not somewhat impact on domestic monetary policy transmission.
So Tomáš would like to follow up.
Well, the yield curve, of course, if one believes strictly in the expectations hypothesis of the yield curve, one would come to the conclusions that the market expects interest rate cuts from the Czech National Bank, but this is not where the policy debate stands at the moment. The forecast itself is consistent with broad stability of the interest rates. Of course, if one takes a bird-eye view and doesn't read in too much into the first or second decimal points, and relative to that, for the medium term, if anything, the board is taking a somewhat hawkish inclination. We are still saying that we see some scope for moderate, gradual, further normalization of interest rates. So relative to that, the market pricing seems to be relatively low. Personally, I think it's more of a reflection of foreign developments than of the domestic situation and the outlook for the domestic monetary policy. And of course, it may change in the future if the market sees that the European economy shifts again to somewhat higher pace of economic expansion.
Thank you. Another question, please. It's the gentleman on my right-hand side.
Kamil Kovář, Moody's Analytics, hello. I have two related questions. One, it was mentioned in the presentation and then also in one answer that we will be converging back to potential GDP growth. Does that mean that the bank views the current situation that we are at the potential level of GDP rather than above the potential level? And second, unemployment rate ticked up a bit. I was wondering what is your view of probability that rather than reflecting the softening in growth, it might be reflecting a start of a return to historically more normal levels of unemployment rate. Thank you.
The Czech National Bank's estimate of potential output growth in the medium term is 3%, which is the, let's say, long-term or medium-term steady state of our core model. And besides that, we have two satellite models to estimate the potential output growth rate and to estimate the output gap in a simultaneous exercise. Both those methods show that in recent years, the GDP, the potential output growth accelerated to more than 3%, approaching almost 4%. In 2015 and 17, and following the deceleration of GDP growth in the second half of last year, the positive output gap, which was given by the fact that the actual GDP grew even faster than the estimated potential growth, this implied output gap has narrowed somewhat. So we are possibly somewhat still above the potential, but not far away from the equilibrium level. And for the future, the forecast implies the GDP growth to be very close to 3%, and the potential output growth rate will also be behaving somewhere like this. So from this, we cannot expect any major change in the position of the economy within the business cycle for the years to come. So we will be very close to potential growth rate. And the second question about the unemployment rate, we tend to look through short-term volatility of all economic variables, whether you are, if I'm not mistaken, you are referring to the latest available figure on the monthly unemployment rate. There will be some tendency of the tightness on the labor market to decline because of the fact that the positive output gap will not be any longer here. We will be closer to the equilibrium level. So from this perspective, the extra tightened labor market will probably be getting into more relaxed shape, but this will take some time. Definitely, as always, the labor market reacts to the GDP with quite significant time delays, and that's why in our forecast we expect that the nominal GDP growth, nominal wage growth in the business sector will decelerate, but this deceleration will be only visible in 2020, whereas this year, following the further increase in minimum wage and following the standard persistence in nominal wages, we can expect that nominal wages will be growing above 7%, whereas the steady state long-term wage growth is 5%, and we will reach those 5% only at the end of 2020.
Thank you, Petr. Anyone else wishing to ask a question? Well, if this is not the case, let me end this meeting by thanking both our speakers and also you for coming and holding a discussion. See you in 3 months' time. Goodbye.